All right. Hello. Just doing this video today for a quick update on recent changes we just made to the investments and something to look out for. You'll probably get several things from TD Ameritrade regarding trade confirmations, things that we're doing. We're essentially getting a lot more conservative right now. We feel like the market has a much higher risk of a potential pullback than in the past. And of course, we've been very aggressive since the end of March of 2020 after the big drop with COVID. With all the stimulus and everything, the markets have really moved up. And I think now we're seeing some signs that we may have a reversal. Now the markets can keep going up, and that's the expectation, that's the momentum. But I think the risk now is getting to be a little bit higher that we will have a market correction, more of a longer term, maybe a larger correction than what a lot of the market expects at this point. And the reason is several things. As far as the timing, here we are in the middle of March. Today's March the 15th, and there's a good chance between now and the end of the month there will be a sizable reversal because of rebalancing. The market's way up, especially on the quarter, and these funds, these target funds and these pension funds, by law have to be set up a certain way. 60% stock, 40% bond, and so there's going to be stocks that are sold and bonds that are purchased. Going into this quarter just for rebalancing. So that will have a negative impact on the market. Should be positive for the bond market, where we'll get a little bit maybe lower interest rates, and this is going to be welcome since interest rates have been creeping up lately. 30-year fixed rates on mortgages have been down around 2.5% at the bottom. Now we're up above 3 again. We're at about 3 1/8 on a par rate. So it's obviously going to mean less refinance activity, less purchases, less cash out. These are all things that have been really a huge wind in the sails of the economy. It looks like it's being pulled back a little bit. And so I think those are all concerns, and that raises the risk. And of course, the main reason that we're concerned about these risks is the current valuations of the stock market are really stretched. They're really high. And so when you start looking at traditional PE ratios, PEG ratios, basically the value of these companies based on profits, they're just, a lot of them are really expensive. Market valuations, just based on historical measurements, tell us the stock market is overpriced. So one of the things you look out for during times of change is volatility in the market, whether we start to see a lot more big up and big down days, and the volatility, which has really kind of jumped up recently. We've seen a lot more volatility in the markets, which also is another sign that we may be coming to a point where we have some kind of a correction. So with a little bit higher rates, which is negative, these are all things that can happen. Now, what will be the catalyst? What will be the thing that causes the markets to really fall? What will be the news? And you never know. You never know what the news is going to be. As you know, we got defensive going into COVID, not because we thought there was going to be a pandemic, because valuations were stretched and the risk was potentially higher. And of course, something happened, COVID, and this, having those hedges on protected us during the downturn. And then of course, we were able to remove those and get fully aggressive at that time. But now, we're starting to see a lot of those risks pop up again. And so it could be anything. And one thing that might happen is, now that a lot of the stimulus talk is done, they're talking about raising taxes. And so they start getting they release a big corporate tax increase or a big tax increase. Obviously the value of a company is based on its future profits. That's what the stock market trades on. It's not current valuations, it's not current profits, it's future profits. And when companies have to pay a lot more in taxes in the future, then their profits are going to be less, so the value of that company is less. And that's typically what happens. And people might say, oh, well, they're going to tax a lot more, but then they're going to take that money in and turn around and give it out to the new green economy, and we're going to have all these new green jobs, and that's going to help the economy. Yeah, we'll see. I find it hard to believe because history has shown us that whenever the government takes a lot of money in taxes, there's an extreme amount of waste in bureaucracy and inefficiency. The government ends up paying a lot more for things than someone that was using the money in the private sector would do, because that person's really trying to get the best deal and get the best cost, where the government has a lot of waste. It's not essentially their money and they waste it and give it out. And, sometimes political to their political friends and so on and so forth, they'll get contracts and so on and so forth. So I just think the risk is a lot higher right now. So you'll notice on the investments, we sold off a sizable amount of equity positions in the last couple of days. And what we've been doing is positioning that into short-term bond ladders as a hedge against risk. Hopefully some of those bonds will do better as they push interest rates back down, which I think is probably going to happen. And so we're watching that. They have, pop back up quite a bit, and there's a significant difference on a 2.5% 30-year fixed rate and a 3 1/8. Obviously, if you have a 4% mortgage, 3 1/8 is great, but there's a lot of people that would have refinanced at 2.5 that are currently at 3 1/4 or 3.5, and they just didn't get around to it. That obviously would be stimulating for the economy for those people to have lower mortgage rates or pull cash out. That's not going to happen at the current rates. And so hopefully we get another push down in rates. It might be one of the last opportunities to refinance at super low rates before they permanently move up. But again, permanently increasing interest rates, higher taxes, these are all things that could negatively impact corporate profits and the stock market. So we just want to be a little bit more cautious at this time, and we're going to keep an eye on it. And if we do have a significant pullback in the markets, then it may give us an opportunity to get more aggressive in the future. And so that's kind of what's going on with the changes you're seeing in a lot of the market investments. We made some kind of blanket changes the last couple days where everyone that's in this investment, we're selling off 40% of the stocks and we're putting a hedge against risk. But then we're also going to be looking at this on a case-by-case basis at each individual client level, and that'll take us a couple weeks to conduct everything. Feel free, by the way, to reach out to us if you have any questions or concerns or want to do anything different. But again, our analysis tells us that it is time to be cautious, at least in the short term with the markets, especially going into the end of March. And of course, one other thing that's coming, which is another potential concern, is April 15th. A lot of money is owed in taxes. A lot of capital gains are going to be owed. They say that this might be the biggest year. They're talking about 1.6 trillion in potential capital gains that taxes have to be paid on. So the latest thing I read. And where's that money going to come from? There's not a lot of cash on the sidelines at this point. So I imagine people might have to start selling some investments in early April in order to get the cash to pay the taxes. And so there's another reason why we want to be cautious with the markets at this point. So anyway, those are all the reasons and what our thinking is. And feel free to reach out to us if you have any questions or concerns. And again, based on kind of our previous track record, if we're being more conservative, we move pretty quickly when we see an opportunity to get more conservative. So we've done that. Your accounts are already positioned for a more conservative future. And in the event that we get more aggressive, we usually let you know in advance, where we say, okay, we're starting to see that now's a good time to invest, and most likely in the next week or two, we're going to be looking for an opportunity. And so that's kind of how we get more aggressive. But as far as conservative, we like to just do it when we see a potential for higher risk. So that's why we did it. Anyhow, feel free to reach out if you have any questions or concerns, and we'll be happy to chat with you. Thank you.